So anyone who has a question for Brian or anything we mentioned, raise your digital hand here or put your question in the chat and can ask Brian some questions and field a little Q&A. So either raise your digital hand there or thanks, Andrew, or just put your question in the chat maybe, and then we will get into some Q&A. All right. Salvatore said, how much time do you spend raising money versus chasing deals? Great question.
That is a good question. Boy, gosh, I don't know. It depends on where you're at. If you're looking for a deal, you spend all your time looking for a deal. Once you get a deal, and you spend a lot of your time looking for the money for it. On the whole, I think you're always looking for deals. And so that's probably going to be the majority of your time. But then when you have a deal, then obviously you concentrate on that. I would say other responsibilities too. So you're probably doing the capital raising maybe 30% of the time, and everything else, underwriting, finding deals, and those things, due diligence and that sort of thing, the rest of the time. But there's an ebb and flow to it. It just depends on where you're at in the deal flow and in your capital raise. The closer it gets to closing and you're not there yet, and you're spending a whole lot more time posting things and calling people. That's for sure.
Awesome. Great answer. I know, Andrew, you raised your hand. Do you want to unmute, ask your question?
Sure, I'll do that. Thank you, Logan. Can you guys hear me okay?
Yeah.
Yep.
Oh, fantastic. Brian, fantastic. I was sitting here trying to figure out when the fireworks are going to happen. In your style is very slow, methodical, like a karate sensei or something. And you don't get to the action until you get all of a sudden, then the fireworks start happening and people start throwing combinations. And before you know it, you got a real choreographed kind of Keanu Reeves feel at the end, right? I'm glad I stuck around because sometimes you look for that hype and that the fireworks, but the style, you have more bang in your delivery at the end that you walk away from the movie saying, damn, I want to see that again. So great job. I loved it. Great style. And I appreciate that. I had a question though. The question was on the properties that you're looking at, that you take in, how many units are you looking for? You say you do 100 properties, you may go through that. I know that feeling because we're mining right now. I'm in Chicago. So in the Midwest, Chicago, Illinois, Missouri, Indiana, Wisconsin, Michigan, Ohio, I said that already, Minnesota, Missouri, those are my stomping grounds. I like it. It's a good feel. For some reason, we're in the center of the U.S. and there's a diversity of architecture, diversity of opportunity. So what do you look for in the units, and how many units would you say is a minimum where you say, no, it's too small for me, or nah, no thanks? What's good and what's a deal killer for you?
Yeah, that's a great question. And thank you for the kind words.
Yeah,
our buy box, we're not going to look at anything less than probably 450 number of units. And C, B, and A properties. Our most recent deal is an A property. But we look for value add or something that is just behind market rates and rent, where we can just step in and raise rents. The property that we've got now under contract, it's only 6 years old, so there's not a lot that needs to be done to it. But the management been behind the times at 16% below street rates. So that's going to be an easy lift for us. Other properties we look at, in particular, if there's some acreage that is unused, that we can either convert into parking or put a new building on, or covered parking, that sort of thing. So it depends on the deal, but we're looking at nothing too small and nothing too broken down. We don't want to do too much heavy lifting with what we're looking at, but that's been our sweet spot for now. And we look at portfolios too, with a combination of units that we could combine under one name, maybe in an area, and combine them under kind of one management and one name, so that there's that synergy, that consistency in a market. But the Midwest, where you are, there's a lot of great opportunity out there. Absolutely.
Yes, sir. I like it. I look forward to finding something. Maybe we can partner up on something out this way. I don't know. We'll see. I'll be in touch for sure.
Okay.
Thank
yeah,
you.
Please do.
You got it.
Awesome, Andrew. Thanks. Great question. I see we had some more. No one else raised their hand, but we have some more in the chat. I know that Keith asked if you do any boat or RV storage. I don't believe you do. You can answer that for me,
We
Brian.
we have RV, we don't do RV parks, but yeah, certainly tractor trailer and RV storage. We've got slots large enough, 40 feet long, to be able to accommodate those two. One of our properties is 7.5 acres, and not all of it was developed. So we've had the opportunity to go in and do some grading and move some fencing and put in more spaces that way. We decided that we got more bang for our buck based on the market where we're at. We looked at what the number of units that we had in our facility as well as in others in terms of size. Was it 10 by 10s? Was it 20 by 30s? What were people looking for? And what we discovered there is people needed boat and RV parking. So we didn't build a building. We just did some grading and leveling out and put down some stripes. And this is just red clay and gravel. So we didn't have to do much to it and just created more space for people to park their larger vehicles. Worked out well. That gave us the most bang for our buck.
Gotcha. Hope that answered your question, Keith. You can always raise your hand or comment to clarify, but it's a good answer. And Salvatore said, how do you make money when you invest in a multifamily deal before it's stabilized? Like, how do you keep the lights on until the value add is done? I'm assuming that's the nature of his question.
You got to look at what your capital expenditures are going to be before you go into the deal, right? That's part of your raise. And another thing that we look for in our buy box is it's got to be already cash flowing. We don't want to do new constructions. We don't want to do these real bad hardship cases where our investors are going to have to wait for returns. We look at properties that are already cash flowing, and we will raise the money that we need to execute our value add at closing. So we don't have to wait for rents to build up to where we've got the capital to do that. So we'll look to already have that in hand when we start from day one. Our investors get paid first month. So for all of our deals, we do distribute monthly rather than quarterly. And our investors enjoy having that cash flow right from the beginning. Now, we don't like something that's interesting that's different from self-storage to multifamily is we don't offer a preferred return, because oftentimes the returns are better and they can start out relatively low. So we can give like an average over, let's say, a 5-year hold of a 10% return, but you're not going to start out at 10%, right? It might be 4, 5, or 6%. But in years 4 and 5, you're at 14, 15%, right? So that's how you have to approach it. And our investors enjoy having that cash flow right from the start. There's no waiting period.
Gotcha. I hope that answered your question, Salvatore. And then Keith said, how many deals, I think you touched on this a little bit, how many deals do you look at for every one you actually buy?
It depends. Sometimes they come one after another. We have been under contract with our current deal now for 8 weeks, and we've probably have looked at another 120, 130 deals since then. And we still think our deal, by the way, is the best one around that we've seen since then. But it depends. There's an ebb and flow to that too. But you've got to constantly be looking at deals and learning what's out there. In particular, if you're going to find those unicorns, those ones that pop up, you're like, man, where's this been? This fantastic deal, and everybody else is looking elsewhere, and you got the great deal, it just falls in your lap. Yeah, always be looking.
Never stops.
Look at a lot more deals than ones that you'll land, that's for sure.
Yeah, whatever you're looking at now, look at more. Seems to be the general gist of it. I hope that answered your question as well, Keith. And Salvatore said, who does your fund admin for paying investors? Brian doesn't have a fund. I'm assuming, Salvatore, you mean like the syndication administration, like the portal? If you want to clarify on that. Yeah. I'm assuming you use Cashflow Portal for that, Brian?
We do. We use Cashflow Portal for that. You pay a fee, but that's about it. It doesn't scale based on how much money goes through it or anything. It's a utility that you use. You just pay a standard fee for it. As for points that you get as being a fund manager and your compensation, you can either just bring money as a fund manager Depends on how you negotiate the deal. You can come in as a co-GP and get GP points that way. But the nice thing about being the fund manager is that you're able to take the money from the fund as based on what you raise and you bring it in. So you get paid that way. And that's the workaround with the SEC regulations, because you haven't brought it to a syndication yet. So you can't get compensated based on how much money you raise and bring straight to the syndication. As a fund manager, you've got that pool of money. You've negotiated with the operator, the syndicators, your terms that help to match your investors so that they are getting the returns that the other investors, straight to syndication investors, are getting, with still being able to get your payment out of it. And it can be pretty lucrative depending on how you negotiate it, anywhere from 15 to 20%. Yeah. So there are a lot of perks, a lot of upside to the fund to fund model.
Yeah. And if Tim was here, he'd be saying, yes, yes, absolutely. Which I heavily agree with as well. I think that it's not as well known as other business models, but I think it's the easiest way to scale capital raising as a whole, because you can raise for bigger deals and get a bigger piece of the pie and stuff like that. But yeah, Cashflow Portal with Perry and Adrian, they're great. If you guys haven't used them, definitely check them out. We work with them pretty close. They're well recommended for sure. So they have a great service. But where were we? So we had some more questions, I believe. I'm on my phone here. So we have time for one more question, I think. Salvatore said, and I'm missing the questions from earlier, but how do you incentivize your investors to put more into your deals and to scale you?
I try not to be pushy. I had one gentleman in this current raise that I'm doing. We were talking and I asked him if he was interested, and he said that he had just sold his ranch and he had some money in kind of an escrow account, and he off the cuff said 750,000 enough. So I said, only invest what you're comfortable investing. Of course, I would love 50,000 at a time. I don't want to come off being pushy or sounding like a used car salesman for sure. And I think if you just stick to what the minimum investment is, you make it clear to people that they don't have to just make the minimum investment. That's the starting point. It'd be 50,000, 100,000, whatever. But tell them whatever you're comfortable doing, and then show them the numbers. You say $100,000 deal, the return on your investment will look like this. If you do 200,000, it's going to look like this. And then when they start seeing the numbers, then they can assess what they want to do based on their risk aversion. And that's it. Just being honest, show them the numbers, show them how it's going to work, and then get that soft commit. And that's one thing. Getting a soft commit, nothing is done until the money's in the bank, right? You can talk to people and they say, I don't know, 100,000 sounds like a lot. Next thing you know, they say, well, I got 250,000 to invest as a soft commitment. And then when you send them the wiring instructions, they get cold feet. It's just keeping on top of people, letting them make the decision, helping them to understand at the level that they come in, what their returns are going to look like. So far in our deal structure, we haven't had very complicated waterfalls like Class A shares, B shares, C shares, things like that. Depends on how sophisticated you want to get with that. Oftentimes, people who put in larger amounts of money will get better terms. And those terms also can be whether or not they are looking to have more cash flow. So they want a higher preferred return on a month-to-month or a quarterly basis, or they're more equity driven and they just want a big payout at the end. So it's just helping them to understand what their investment's going to look based on the level of money that they bring to the table.
Awesome. Awesome. I know Salvatore has some more questions. What we'll do is I'll probably put you in a breakout session with him if you can stick around, Brian. But that'll wrap us up for the Q&A. Again, I really want to thank you, Brian, for coming on and answering so many questions and giving us your time. And sorry for the technical difficulty there. But so we're going to put you guys into breakout sessions. But before we do, you guys know the drill. We're going to do a group picture. So everyone turn your cameras on. Everyone cameras on. And you guys know our pose. We flex. And I'm on my phone, so you can't do it as well. But we flex. So everyone turn on your camera. Do the group pose here. Everyone ready? Turn on your camera. 3, 2, 1.
Yay, awesome.